All right. So once we have the pizza trickle crowd come back in, excited to kick this off. So first off, my name is Aya. Huge shout out to DeFiCon for hosting this conference, and excited for our conversation today with our panelists. Just to kick off introductions, I'm the head of institutional coverage globally for Falcon X. We are a digital prime brokerage. And then I will kick it over to John.
Hey, I'm John. I'm COO at Gauntlet, where we're building a platform for building financial models for crypto. We focus on risk and incentives. We currently manage risk for about $30 billion of assets within DeFi. And we think about liquidity a lot, whether it's liquidity mining incentives or how liquidity affects risk in various different protocols. It's always top of mind.
Hey, I'm Alex. I'm a co-founder at Hedgey Finance. We practice building DeFi protocols for DAO Treasury risk management, and I'm also an active advisor for Venus Protocol.
Hey, and I'm Ben. I am the head of marketing at Ichi. We do liquidity management for other crypto protocols. So we build on top of flexible AMMs and utilize concentrate liquidity so that users can have their money work better for them.
Perfect. So why don't we kick it off with just talking about trends at large. This DeFi summer is a little bit different than the last DeFi summer, and I'd love to get your perspectives, just given where you sit and what you're working on how, whether it's liquidity or even tokenomics, how has that changed in the way your company is looking at it today and the companies you work with today as well?
I think, as you mentioned, this summer isn't quite as warm as the last couple, but I think that one thing that's done is it's really kind of separated the wheat from the chaff as far as protocols and tokens go. And so I think one thing we saw is that there was just like growing retail demand for tokens. Literally any token, will take it as long as it's a token, and that's going to create some really weird incentives in the market where it might, you might be able to LP in Uniswap, because you're getting paid all these token incentives, and those have a strong incentive effect because you can dump them on retail. And you no longer can just continuously dump liquidity mining incentives on retail. And so I think that's just going to focus people on use cases that have more real utility, especially just within DeFi. I think there's been a greater liquidity crunch across DeFi and CeFi. But I think in DeFi the biggest change has been there's just no longer runaway demand for tokens passed out via liquidity mining.
Yeah, it's an interesting point. I think capital is kind of fleeting in that sense, where you just go to the highest yield farmer that's available. I think the last cycle, with the ICO cycle, there wasn't really much yet in the real world that the protocols had use for, and we've now seen a lot of financial innovation and a lot of liquidity innovation where I think it's gotten more deep-rooted that we can actually build on top of with things that are like yield farming and liquidity incentives, but now I'm hoping this next cycle we turn that into something more productive where there's actual protocol yield that's given back to sort of token holders. Let's not call them investors, but token holders and other ways to incentivize tokenomics beyond sort of just basic yield farming.
Yeah, and I agree with that as well. I think we've seen a lot of fake yield in DeFi over the past years. I think with DeFi summer, there was just a lot of hype around just the idea of decentralization as a whole. And all of the systems that were in place before, much of those were just projects giving their own token to liquidity providers. And it wasn't actually capital efficient. It wasn't helping anybody. It was just draining this whole system and creating this hype of, look at this crypto world. But the technology that was being built in the background wasn't necessarily being used as intended. I think with the crypto winter we're in right now, we're starting to see the projects that are successful. They're the ones that are coming up out on top. The ones that were doing these almost fake yields, almost harder to I think it's difficult for these crypto projects to survive if they're giving these fake yields. And the ones that are doing it the right way are the ones that are going to come out on top.
Yeah, I think that's right. I mean, at the end of the day, like we got to go through these cycles every couple years. You know, as the Godfather would say, get out the bad blood. You know, and I think, yeah, there's a lot of stuff that's here to stay, and we're going to build on. I want to clarify, it's not a winter; it's a build market. But I think there's a lot of great stuff coming out that's innovative. That's like now going to change what we do in the next couple years.
Yeah, so let's dig into that a little bit more. We talked about some of the obstacles, whether it's tokenomics or you know, if it's cross-chain, you're seeing basically yield farmers who are kind of moving from these different projects, gathering yield, moving to the next project, so on and so forth. There's a difficult way of marketing to users in DeFi where you've seen some of these token launches work in that capacity. What needs to change, or what's changing? How are tokenomics different now? And then for users who are looking into DeFi, how do you recognize, like, once you start onboarding onto a platform, this maybe has longer incentive for users and the platform versus something that does feel like a faster churn cycle?
Sure, I'll kick it off. So one of the things that I'm helping Venus with is redoing their whole tokenomics, and part of that is trying to avoid the sort of fleeting nature of capital that people put into the token to get rewards and get incentives. And I'm certainly not the inventor of this, but one of the neat things that I think we're doing is instead of sort of people having to stake and you earn up front, you actually have to participate up to a certain length, and then you're rewarded. And so you've already got to prove that you're sort of like willing to capture and stay on board before you can actually get those incentives. And once you do that, then as soon as you withdraw or you unstake or get out of it, you're sort of like kicked back to the back of the line. And I think that's a way to sort of incentivize people to become true proponents and, you know, stay within the ecosystem, you know, which they're providing liquidity, in which they're participating, and, you know, offer like bonus metrics of actual real yield to those people who are participating at length with the ecosystem and token staking.
Yeah, over at Ichi, one thing that we do that makes us stand out is we show our yield via IRR, internal rate of return, which is the historical yield that people have earned from, you know, maybe the past 30 days or past since maybe a vault or pool was created. So we're not necessarily promising future returns that may or may not be there, but we're just showing this is what has been here, and this is what it's actually doing. And it counts all of the various factors in yield, such as impermanent loss, token growth, everything. It really gives people a real idea of what is actually happening.
Yeah, you know, I think that stuff is really a helpful step forward for the space, just being more honest about yields. I mean, I know I participated in some farms that had like 4-digit numbers in the yield. Yeah, I got 3,000% on pickle. I don't know what it was 3,000% of. It wasn't pickles. But you know, and so I think that, yeah, the space getting more honest about stuff is going to be really helpful at building trust, and trust is essential to growth. But I'd actually say I'm kind of bearish tokenomics. I feel like people have kind of been slapping new tokenomic models on the same couple DeFi protocols. And like in the end, tokenomics can improve a good idea, but they can't create demand for a bad idea. And I think that's what was really driving a lot of the sort of fervor in DeFi summer and you know, and I think the liquidity mining craze after is that, yeah, people were just gambling on bad ideas. Or like, I don't know, does anyone remember Swerve? Swerve was just a fork of Curve, and there's a million of these things, and there's like $1 billion each one of these protocols. Like, yeah, you know, they did have different tokenomics, and distributing ownership is essential to growth, and it's one of the key innovations of Web3 and DeFi. But you should distribute ownership in something useful, and I think that, you know, as we mentioned, we're in the build phase, and I'm excited for people to build more useful stuff, and I'm kind of bearish tokenomics in the short term.
Yeah, I'll jump in real quick. From a marketing perspective, it's always really funny to look at projects and ask the question, is this just really good marketing, or is this actually good utility? You know, is this real yield? Will this actually provide me some value? Or is it just a really cool marketing campaign? And there's a real fine line between good marketing and then good product. And the best one's the ones that do both.
Yeah, I would almost double down on that. I think crypto in general, from a marketing perspective, we love labels, and so we'll throw labels on a ton of different things. And here it's almost like a metric-specific question, which is, what's the right metric to track? And to your point, because everyone's been tracking TVL so closely, and it's what is a total value locked, and trust is built if you hit over 100 million or a billion, therefore it must be a trustworthy platform, but maybe TVL isn't the right metric to be matching. You know, IRR is one. I'm sure there are a number of others that could lead, you know, users to actually track better use cases.
Well, TVL is great, but if you can't monetize it, it's kind of useless. So really, like protocol revenue, when we get to that point, I think is going to be the most, you know, honest description of how a protocol and the tokenomics actually exists.
Mm-hmm. So why don't we shift gears? In terms of timing, you know, we're headed into the ETH merge, and that's going to be a huge shift for the space, going from proof of work to proof of stake. How do you see that impacting liquidity, and what are some of the maybe unanswered questions that the DeFi has, or obstacles you see us running into?
You know, I think there's really kind of two ways I see it affecting liquidity. One, as the space matures and things like the ETH merge and various L2s and things like that, they're going to help with scalability. As those mature and proliferate, you're going to have better liquidity because there's lower transaction costs. So I think that that's like directionally going to be helpful for the space, but we're not going to probably see a lot of the fruits of that for quite some time because it'll take time for things to sort of develop. I think second, there's also just going to be a lot of market activity around things like staked ETH and ETH. You know, one thing that we do at Gauntlet is we manage risk for Aave, and they allow for staked ETH collateral. And one thing we spend an inordinate amount of time thinking about is the risk that derives from the liquidity between staked ETH and ETH, because as those prices diverge, that can create you know, issues for people using staked ETH as collateral. And so yeah, we really spend a lot of time thinking about that. I think that people trying to bet on you know, the merge maybe not happening, or you know, the various forks that are cropping up. I think that, you know, that's going to create some volatility in the space. So that'll make for an interesting couple weeks, I'm sure. Especially because there's a lot of leverage around staked ETH and ETH. There's an InstaDApp like tool that allows you to lever up lever up a bet on the staked ETH spread. And so a lot of people have been using that. And so yeah, there's a lot of exposure in the market, and so that'll probably create some ripple effects, as we have seen over the past few weeks as the staked ETH price spread has diverged and then mean reverted.
Well, and just to clarify, it's only the Lido staked ETH. Rocket ETH is somehow priced above ETH. So it's a weird world that we're living in, right? But like, I agree. I think it's interesting. What's interesting to me is like most liquidity pools and everything are denominated in token and ETH. And so if you're LPing in token and ETH, you're now giving up your, you know, sort of base level staked ETH interest yield. And so I think one of the issues that we may run into is people pull out their ETH to stake it, and are we going to see just like liquidity pools of staked ETH versus token, as opposed to token ETH? Because why would you not want to stake your token, or, you know, LP with token and staked ETH when you would sort of have that economic opportunity cost of missing out on it? But then you've also got like staked ETH, which I think is really cool, becomes a base layer interest rate that now all money markets and everything else sort of has to live on top of and decide, is this economically, you know, opportunistic beyond the 5% or you know, 4.5% or whatever that you can earn on staked ETH, and so it'll be more competitive on the interest rate schema, which I'm excited for.
Yeah, I think the merge will really open the door to liquidity on mostly centralized places, centralized exchanges, going into decentralized because of just all of the options, like the interest rates, everything you just described. There are going to be so many more options, and will this be the base layer everyone uses? Also, will this open the door for, you know, new technology, new protocols building on all of these new systems? We'll see what happens. I think it'll be really interesting. Even just the news leading up to, you know, when is it actually going to happen? What's going to happen to the market leading up to it and then after?
What's a world in which, let's say, the miners decide they don't want to move away from proof of work, and you have continued liquidity in ETH as we know it today, what impact would that have to liquidity in DeFi? And is there some standardization that you've seen or is needed for projects to fully shift towards proof of stake ETH?
You know, I just am so bearish on the proof of work forks. I think that they're noise. They might make a very loud noise, but in the end, I just don't see them being a big part of the DeFi ecosystem going forward. I mean, Ethereum Classic is still around. People I know use it, but maybe no one I respect does. And so I don't know. I don't have too much to say about the proof of work forks. I don't know. I'm fully on board with the merge.
Yeah, I mean, I think unless there was some reason people didn't have consensus on the proof of stake, proof of work is sort of like a fleeting experiment that people are going to try and profit and proliferate on, over the next the 3 months, following, and then it'll sort of die out. But that's not financial advice.
Yeah, I mean, they'll be there, at least for the short term. Who knows long term what will actually happen? Will there be good protocols in the future that make it work? I don't know.
We talked about a few of the obstacles in DeFi. Over the last 3 weeks, there's been a number of hacks, whether it was associated with DeFi directly or not. Bridges, Nomad, you had Solana, you had a number of others. It's always something that's relatively top of mind. How do companies or protocols in DeFi, how has that perspective shifted or maybe stayed the same across all of these hacks? And then for users, how should they think about it as well?
I think for a lot of protocols in DeFi, I think using tokens as collateral, I think is the thing that exposes you to the most risk for many of these hacks. I think, especially when you look at something like the Nomad hack, a lot of protocols that used Nomad bridged assets as collateral are now they have bad loans on their books and things like that. And I think that the best way to deal with this more broadly is bridges aren't really special. They're just new sets of smart contracts that people just haven't been using them as long as Maker or something that hasn't really ever suffered a hack. And so it's just we got to let these things bake. Many of the leading lending protocols have functionality in their smart contracts to limit exposure to particular assets. Things like supply caps and borrow caps, and I think that we should continue to lean on those heavily as we, continue to integrate new systems that create systemic exposure throughout DeFi.
Yeah, I mean, unless it's a true layer 2, I'd be in favor of no bridges. Just you live over here, you live over here, and you live over here, and let the centralized exchanges manage. Okay, I can swap my ETH for ETH up here, and send it to BSC or Polygon, whatever. And the true L2s, you can bridge back and forth. But everything else, I avoid bridges at all costs. Yeah, too many. Everything's going to get hacked on a bridge.
Yeah, we've seen lots of hacks on bridges, so I don't blame you at all for being bridge averse. I think if you think about liquidity, the places that will be successful is the chain where liquidity lands. So I don't know how bridges will transform over the future. But in terms of, what can you do to manage risk or avoid hacks? I think one thing that we really try to do is just think about the customer first. How risky is this for a customer? How many controls need to be in place so that the customer can still make all of the decisions in a decentralized way that we want them to, but are there enough controls so that they'll be okay? Are there enough audits? Is there enough security taken into perspective? Are you doing enough audits? What are you doing so that the customers are happy? And then once you do everything you can, it's then up to everyone else to figure out what to do.
I mean, at the end of the day, most bridges are semi-centralized, which I think if we can get to a place where it's decentralized in a actual way, like in an actual L2, then I think I could get more comfortable. But handling billions of assets on a multi-sig is not something I want to sort of take a risk on.
It's an interesting perspective. Digging into liquidity management, what are some of the tools or best liquidity management projects that you have either worked with or recommend to projects today?
Yeah, I can jump in here. With Ichi, we have seen a really big trend just across DeFi looking at TVL. So if you go and look at total TVL over the past few months in DeFi, we've seen a pretty significant drop. And I think a lot of that is due to the kind of the fake yields and just, crypto winter or builder winter, as some might say. But the other thing we've noticed is that people are really happy and sort of moving money over to places like Uniswap, where they have created really flexible, cost-efficient systems that utilize concentrated liquidity. They're more cost-effective, cheaper for users, and a lot of the money is flowing there. They have great routing practices. They have this new way of doing things. And with Ichi, we've noticed that, and we actually build on top of that. So we help manage people's positions on sort of Uniswap and these flexible AMMs because it's cost effective, it's helpful for people. They're spending less on gas fees, and just seeing the overall flow of just total liquidity in DeFi go to these more flexible models, I think is a really key indicator that these systems are needed in the future.
Yeah, I think there's a lot of liquidity protocols out there. I know that there's many new ways for you to spin up, stable coins or, a new borrowing pool with Rari. I'm actually a proponent of responsible liquidity management, which is one of the things that we do at Hedgey, where distributing tokens in a locked sense or based on different parameters actually prevents people from distributing too many tokens liquid that actually hinder a lot of the market participants who are already providing liquidity that then suffer. So I think I think we'll see a future where there's a new responsibility in sort of token distribution that's got vesting and locking mechanisms and stuff that's beyond sort of just providing liquidity to earn incentives, but you can actually do that in a more responsible way over a longer term that ties long-term incentives with whether it's investors, token holders, employees to the long-term alignment of the DAO and the protocol.
So I think there's kind of two ways to look at liquidity management. There's people, you can look at it from the lens of people providing liquidity or the people that, might derive utility from liquidity for a token. And so I think, for people providing liquidity, especially in ETH, you see almost all of the trading and stuff like that moving to concentrated liquidity style AMMs. And I think that trend will likely continue. I think it's going to get harder and harder for a retail user to provide liquidity in something like UniV3 because it gives the other people providing liquidity a lot of tools to basically get a disproportionate share of fees. And so there was this cool thing about UniV2, which is that it was incredibly egalitarian because everyone had the same market making strategy. But that's actually not a particularly efficient way to provide liquidity, and UniV3 solves that problem. But what it does do is open up maybe less sophisticated participants. It opens them up to basically having the same or more exposure to impermanent loss with less of a chance to earn fees that would offset it. And there's lots of people building protocols in the space that are trying to help solve this problem. But in the end, if you're market making, news is bad. If there's news that changes the valuation of a token you're trading, you'll have directional exposure to it. And that's going to be a hard thing to manage over time. And there's going to be sophisticated market participants who are able to, at size, manage exposure to those sorts of events. And it's going to make it really hard for other participants to basically keep up with them in the long run. And I'm really excited to see innovation in this space that might be able to address these issues. And then I think from the lens of projects that need liquidity for their token, you're also probably going to look at UniV3 because with much less investment of your token in a trading pair asset, you can create similar support for trading of your token. And I think that you're going to see a lot less of DEXs distributing their token to encourage liquidity for other tokens on their platform, and more people distributing their token, or more projects distributing rewards to people providing liquidity for their token itself. Because yeah, I think it's really hard for DEXs to bootstrap liquidity across tons of assets, and they don't derive necessarily direct utility from that. However, any project that has a token, if they want that token to have value, they need some liquidity for it. And so I think the liquidity mining rewards are going to shift more towards projects incentivizing their own token.
Yeah, it's funny from, what we do at Ichi is, directly manage these, AMM, concentrated liquidity pools. And we would argue that, yes, right now it's so hard for users to actually use the thing. It's really hard to always be looking at your position. You're always worried about impermanent loss and all of these various problems with the system. But all the problems are just due to it being expensive and almost too flexible in a way. But if you can have a project or a protocol come in and manage it all together in a responsible way that can actually mitigate impermanent loss and provide the liquidity that's needed for all of these projects, you are creating this just good system and almost the standard for how liquidity is going to work for any project, new or old.
I think the issue too is also like DeFi is currently trying to service all personas in relatively the same way. So if you think about liquidity provisioning against treasury management, two very different things. So protocol trying to get treasury management is very different than a market maker giving liquidity provisioning to a token project. And so for all the reasons mentioned, or for example, retail just trying to get yield, relative yield on their token in the form of, let's say, Anchor, which is much easier to manage RP in than like Ichi or even, let's say, Uniswap v3. How have you seen DeFi try to service these different types of personas? One might focus on specifically protocols with treasury management. One might focus on just an easier to use, retail or high net worth individual interface. And then one might be 100% for market makers who have built algos, who are highly trained in market movements and have size to utilize those tools. But how have you seen different protocols target specific personas as well?
I'm not sure that I have. Outside of a few things. So I think like Balancer has a thing called a liquidity bootstrapping pool, which does solve this problem of, hey, I'm launching a token and I'm going to distribute it to users, and they need some way to determine the value of it. So create this liquidity bootstrapping pool, and it'll feel like this token has value. It might even also have value too, but I'll let you all be the judge of that. But yeah, outside of a few things like that, I think, yeah, you're probably right. There hasn't been a lot of focus on the various different users here in the space, and yeah, I'm looking forward to innovators in space who might be providing new solutions for liquidity management and things like that, or treasury management that might better target some of those users.
Yeah, it's a good point, like segmenting the market out where retail may not be able to participate against a market maker who's sort of taking a counter position. But I haven't seen this yet, but perhaps there's a way where there's sort of side pools almost that participate against other large holders that don't get bullied around as much. It's interesting. I haven't yet, to John's point, I haven't really seen it differentiated by segment or by sort of investor persona.
Yeah, there's always a need for a more niche solution. Agreed.
Great, good idea if anyone in the crowd is building something like this. So focusing maybe on CeFi to DeFi, has that train, has there been a trend of liquidity? Obviously now there's kind of been liquidity pulled out of the entire system, whether it's CeFi or DeFi. But have you seen more trends of CeFi entering into DeFi, or more use cases where the two are working together? We talked about exchanges versus bridges, or anything else there as well.
You know, I don't know if there's any like trends I can pull out from that space, but I would say that I know I'm someone who's very bullish on DeFi, and I might have said some maybe even rude things about CeFi at times. However, most of the money that exists is in CeFi, and it's really easy to, for many assets that are well supported in CeFi, trade them on exchanges like Coinbase, et cetera. And so I think that's probably going to be true for a long time. And if you care about liquidity in this space, you're going to have to think about CeFi, regardless of your religious fervor for DeFi, or maybe not everyone would go that far, but I might. So I don't know. I think CeFi is going to be around for a while, even in the most bullish case for DeFi.
Yeah, I agree with that. I think the DeFi principles are what everyone is really excited about. Just decentralized, permissionless. You're not having to rely on a third-party entity. There's protocol and liquidity. There's community control. All of those principles are important when you think about this whole DeFi movement from CeFi. But like you said, most of the money's in CeFi right now. So how can you take it? But you almost can't. You almost need to figure out a way to work with CeFi and bring those principles and that money into DeFi solutions so that you can get the principles of DeFi into a place where it can be mass adopted across the world in normal everyday life by normal everyday users who can actually use it. It's really hard to use DeFi protocols right now if you don't know anything about it. So the ones that will combine the two, I think, will be the winners. But who will be the one? I don't know.
Yeah, I think at the end of the day, the biggest problem is credit generation. Because CeFi has the advantage where they can act like a bank, and they can basically pool users' funds and give it out to margin loans and credit. And like DeFi, we haven't solved that problem. If we can solve the credit problem, there's no reason for CeFi to exist. How do you solve that credit problem is a whole nother can of worms. Is that through, Vitalik talks about soul-bound tokens that sort of have your resume and everything you've done, and perhaps you can attach DeFi creditworthiness to that, which I think is really exciting. But at the end of the day, I think that's where we have to go is establishing, and I know MakerDAO is sort of doing a sort of bridge with credit, which I think is really exciting, and Maple and Goldfinch are trying to do some of this stuff. But I think at the end of the day, we have to get to a point where there's real credit generation, because that's like where all the money is, right? And that's how it actually exists for us to use it. And until we solve that problem in DeFi, then we always have to rely on CeFi to solve that problem.
Yeah, I couldn't agree with you more. I think Maple and Goldfinch are really, Maple being like more institutional DeFi, and then Goldfinch actually real world use case with that credit scoring piece. That's super interesting. I mean, the capital inefficiency of DeFi is just so high that collateralizing something 120%, despite having receipt tokens, it's still just capital inefficient. People want under collateralized lending, and the credit market is the largest market in the space globally. I think another challenge for that is obviously the fact that there's cross chains, and this is where you get into the problem with bridges. How do you see that shifting? You talked about soul-bound tokens, which I agree is a very interesting concept. The issue with credit scores in general is, when you have multi-wallets for one specific user. But how have you seen the collateralization or the credit piece shifting in DeFi?
So I haven't really seen it yet, but I will say I'm working with the Venus team on doing sort of a unique bond offering that taps into the protocol revenue directly. That sort of is almost like protocol collateralized bonds, which may have a new credit backing, and we can go into like sort of all the algorithms that it's based on their markets and stuff. But I think protocol collateralization could be an interesting way that we establish some credit where it's almost like a collateralized loan obligation or a CDO that sort of has tranches and waterfalls based on the revenue the protocol earns. But protocols have to earn revenue for that to actually be financeable.
Right. Yeah, I think DebtDAO is also working on something like this.
Yeah, I think the real world asset team on Maker and in projects like, Maple and whatnot. Yeah, they're doing some really interesting stuff. I think a lot of people really worry about basically the exposure to off-chain risk because you're relying on off-chain entities to basically recoup funds in the case that someone doesn't pay them back, or maybe even take legal action against someone. And I think all that stuff is probably bad to rely on if you're only relying on one like legal entity to enforce the solvency of these assets. However, if you're able to actually have diverse exposure across different regulatory regimes, geographic locales, things like that, you start to have something that does look a little decentralized by lots of centralized pieces that have come together to create it. So I'm actually very optimistic about solving the credit problem. And if we're innovative about how we think about decentralization and if we really think about censorship resistance from more of like a threat modeling perspective as opposed to one where we have like these vague principles we try to uphold. And if we really sit down and say, hey, what would happen if someone tried to censor this? You'd actually probably have the conclusion you could say, hey, well, actually, many protocols can have exposure to censorship. It just needs to be like backstopped in some way on chain, and you need to minimize your exposure to any one particular censor. So I think I'm really excited for the space to continue to grow there, and I know a lot of people have, said that Maker's maybe not as decentralized as they think it is because they have this exposure to off-chain assets, and I think that that's really kind of going away, and people are realizing, hey, those off-chain assets have something that very true on-chain assets have, which is real cash flows coming from productive activity. And that's pretty cool, and I would love to see more real cash flows coming from productive activity in DeFi. Hey, some of that can happen on-chain, but in the meantime, we should be smart about how we incorporate them from off-chain sources.
Yeah, I love that. Yeah, I mean, I feel like you said everything that I would ever say about it. But, you put the right controls in place, you figure out how to integrate things the right way from, if there is some sort of centralized entity that has to be part of it, how can it be out in the open, and how can all of the people know what's going on with money and collateral and everything?
What is something that people may not know about DeFi liquidity that you would want the audience to take away from this panel today?
I don't think this was on our list of questions we got before this. So I'll let you guys go first.
So I've got maybe a counter opinion. Maybe it's a pro opinion, but I think we need less stable coins, but we need more money market mutual fund coins. So I think we should really get down to like 1 or 2, maybe 3 top stable coins. But realistically, all the other stable coins can be stable coins. They are just treated more like a money market mutual fund where you're earning, call it a rebasing token. You're earning dividends based on the collateral that you've put into the back end that's actually being used productively to earn interest. And so rather than think about them, well, I've got 1 USDC always. Like, why don't I have 1 USDC and a month later I've got 1.01 USDC? Because the collateral that I've put into this, USDC is a bad example, but the collateral I put in, is earning me interest. And actually, that's what USDC does. So they should be turning themselves into a money market mutual fund. Yeah.
That's cool.
All right, guys. So we might open it up for one last question from the audience. If you want to choose a lucky person to take a question from.
I see one in the middle.
I guess the question is about real yield and the implementation of different kinds of yield.
I'll jump in. I'm a huge fan of real yield. I think the biggest thing you have to worry about is not being a security until perhaps we get regulation in a place where we can become security tokens, and then I'm even more excited about security tokens. One of the ways that I've seen this happen, working on with Venus, is sort of a way for a cash back mechanism for the protocol revenue to be earned back to protocol users based on their usage, almost like, think about like your credit card. As the more you spend, you get a cash back, paid in the same currency that you're borrowing and lending against. Big fan of real yield.
All right, great, guys. So big up to our awesome panel. Oh, sorry, did I interrupt? I know. Yeah. Just like finishing notes, like.
We all love real yield.
I actually don't like real yield. I'm at a fake money conference, and if someone makes this real and moves it to FIDI from Bushwick, I'm going to be pretty pissed.